In earlier videos, we talked about the balance payments accounts and how double entry bookkeeping required that the current account balance, that is the trade of goods and services, exports and imports of goods and services, the financial account balance plus which is the private financial asset trade, exports and imports of assets by private individuals, and the official settlements balance have a particular relationship in that the sum of those exports and imports of each one of those components has to add up to zero because of the double entry bookkeeping. I'm going to focus on interpretations of relationships within. In particular, let's take a look at when a country is running a current account deficit. That is that there's more imports of goods and services by the economy as a whole than there are exports. So this is a kind of broad measure of a trade deficit. Now, by the relationship above, it must be the case that there is a surplus in the sum of the private asset trade in the official reserve transactions by the central bank. That is, that there's an export of assets in order to pay for the imports of the goods and services. So this is exporting assets. Now, what do we mean by exporting assets? It's like selling off some of your stuff, some of your wealth, in order to pay for your current consumption of goods and services. So exporting assets is another way of saying that there is international borrowing by the country. Selling assets, you're selling your accumulated wealth in order to pay for your current lifestyle. So whenever a country is running a current account balance, a current account deficit, that means that they are borrowing abroad or exporting assets to pay for it, by either from the private standpoint or the official settlement standpoint. By the same token, if you have a current account in surplus, that the exports of goods and services exceeds their imports, then we have the opposite relationship, that there's an import of assets, international lending going on. So you're importing assets, importing claims to future income. In other words, the country is an international lender because you can think of it as in the following way. The country is importing, say, a bond. And as they import these assets, import the bond, they are essentially loaning the money to the foreigners in order to run their own current account deficit. So, current account surplus means that a country is an international lender. A current account deficit means that the country is an international borrower. Now, there's a relationship with national income accounts which will make this even clearer. Again, let's take, for example, the situation where a country is running a current account deficit. From other classes, you may be familiar with this relationship. That national expenditure by consumers on investment goods, government spending on goods and services, plus exports, the foreign purchases of our goods and services, minus the imports, is equal to basically national income. Now, there's some adjustments to national income and expenditure, which technically should be made, but let's set that aside. Basically, national income equals the expenditure. This part right here, exports minus imports of goods and services, is basically another way of writing the current account balance. And this is goods and services. So exports minus imports of goods and services is basically the current account balance that we've talked about. Another relationship that you may have seen before is the following. Again, setting aside the slight differences between expenditure and national income, we can basically say that national income can either be consumed, it can be saved, or it can be taxed away by the government. So income really fits into one of these pots. So we have these two relationships which are equal to the same thing, equal to y. We can then rewrite those two equations. Okay, they're both equal to the same thing, so we'll set them equal to each other. C's cancel, and what we're left with is the following relationship. That the current account balance is equal to net private savings plus net government savings, tax receipts minus the purchase of goods and services. So let's take a look at this then again with what we've talked about before. If you have a country running a current account deficit, we said that the country was a net borrower in international markets. Okay, that's what we started out the video. Now, let's take a look then at this relationship written in a slightly different way. Okay, the current account balance, based on these national income accounts, is equal to net private savings plus net government savings. If the sum of these two things is negative, that is that there's insufficient net private savings and or insufficient government savings to pay for its expenditures, then the source of the lending, the source that allows you to invest more than you save or spend more in government services and goods than the tax revenue, that comes from international sources. So the combination of these two things really shows that a country that is running a current account deficit is a net borrower on international markets. In the same way that if a country is running a current account balance surplus, then savings exceeds investment, and or tax revenue exceeds government expenditures. So again, this makes clear how current account balance is tied into these domestic savings relationships. Okay, so that's again an interpretation of the current account, the deficit or surplus based on balance of payments accounts and national income accounts. If you look at this YouTube site for other economics related videos.